Hi everybody, it's great to have everyone here on this webinar. We have an amazing turnout. I'm very pleased with all the people, and thank you for taking time out of your busy day to learn about multifamily investments and commercial real estate. My name is Karen. I'm with Emerge Investments along with Stan Baggett. We'll both be speaking with you. I also want to remind you, after our about 30-minute presentation, we have our special guest, Karen Hall of UDirect IRA. I've worked with Karen for years. She is truly the self-directed IRA expert, and you won't want to miss what she's got to say. So we're going to go ahead and begin our presentation. At the end, we'd like to take some questions if we have enough time and hopefully be able to answer everything for you. So we're going to talk about multifamily investments, and Emerge Investment is our company, and it is a privately held real estate company which works with investors for high-yield returns. To begin with, as I mentioned, we have nothing to sell. We have no boot camps. We have no classes. We have no books or CDs. We are just providing you with information and open up your eyes about different types of commercial real estate investments. So you will not be sold anything at the end of this. Our objectives for tonight, we're going to discover how to invest like wealthy institutional investors, what is a syndication and how it's a huge advantage for you, why now is the time to buy commercial real estate properties, and we're going to compare single-family investments to multifamily investments. What type of investments are you looking for? Are you looking for security, low risk, high yield, transparency in your investment, and passive income? We're going to discuss all these along with how you can invest in real estate without the headaches of tenants, toilets, and trash.
We currently have ownership in over 900 apartment units. All of them at this time are in Texas. We are a strong community-oriented company. I am a past president of Rotary, the local chapter here, of which Karen is also involved with our children in Lion's Heart, which is a community service organization. I am also president and owner of ST Baggett Inc., which is a general construction. We build commercial projects all over the United States, big box retail, hotels, self-storages, anything commercial-wise. We have built in the past residential. When I say residential, it's multifamily, not houses. We've built, owned, and managed our own facilities for a number of years in California. At this time, we don't own any properties in California. We have some commercial properties in Nevada that we own, but nothing in California. And we're focusing all of our efforts at this time in Texas. Some of the projects that just real quick glance at them is Windsor Place in Abilene, Dovetree and Tyler, Hunters Ridge in Abilene, and another one, Crystal or Cedar Creek in Abilene also. Our latest acquisition was 165 units in Houston, which is Crystal Falls. Outstanding piece of property this is. This is financed through HUD, which is a 35-year loan at an outstanding rate, making extremely good cash flows for our investors.
We're going to talk a little bit how to invest like the wealthy institutional investors. How are they doing so well with their money? Well, their biggest thing is investors pool money together. You can buy a larger, higher quality property. You can buy a REIT quality property, but you're not getting lost in the fund. You're not one of hundreds and hundreds of people that's part of hundreds of properties. With a syndication, you hold an equity position in a specific property. You know which property is yours. You know when it's bought. You know when it's sold. You know how it's doing. You are the owner of this property. We also have professional property management, which means no work for you. No headaches for you, none of the day-to-day problems. This is all done through a syndication. Syndication is basically an opportunity to pool funds together with private investors like you. You are called private investor partners. We currently, in our syndications, only use accredited investors. Most of you know what accredited investors are. They are people that have an income over $200,000, or with your spouse $300,000, or you have a net worth of $1 million that does not include your home. This is considered an accredited investor. For our properties, we only use accredited investors. As an investor in a property, you're under one LLC entity, and that LLC only owns one property. So you're not getting lost in everything. You know exactly what you own. You're also in an equity position, which is a little different from most REITs. And under a syndication, all SEC guidelines are followed. We have an attorney file all of these documents for every state that we're involved in.
Why multifamily now? As all of you know, the mortgage business took a hit, and right now the rates are just phenomenal. Especially on multifamily, we can get 30-year fixed or a 30-year fixed due in 10 for under 5/8, which is a phenomenal rate in this industry. There's less risk with vacancy. If you have 100 units and you lose 4 or 5 tenants, you're not hurt like you are if you have a fourplex and you lose 2 tenants. You lose half your income and you can barely make your mortgage payment. When we purchase a property, we're buying with very small value add opportunities. There's a lot of risk properties out there right now that are in the low 50 to 60% occupied that needs a lot of work. We're not interested in those. Not that they're good properties, but we feel like for our investors, the best thing for them is to buy a property that cash flows immediately, where the rents are a little bit low, and there's minimum amount of work that can be done to spruce up the property and increase the occupancy. We won't look at anything under 85%. It's got to be 85% occupied and above to interest us. The baby boomers, the echo boomers, they're the ones that are renting right now. And as you read in the paper more and more, the home ownership is taking a hit. We only use professional third-party management teams. So we don't want to manage it. I've managed properties in the past, and it's just it's much easier to keep going under third-party management. Karen and I work very well together in here. She takes care of the management and all of the aspects where I tend to locate the properties, analyze them, do the site analysis, do the research, and get them financed. So as a team, we work very good together in that aspect.
A lot of people are working as a single-family investor. I always look at these pictures and think, which one do I want to be? Do I want to be the single-family investor that's putting all my hard work and not getting any rest? Or do I want to be the multifamily investor that's shopping and enjoying life? For us, it's all about positive income and enjoying life with family and friends, which is why most investors go into syndications. You're not doing the day-to-day operations. Imagine opening your mailbox several times a year and getting a check with no work on your part. We're going to talk about the differences between single family and multifamily. This picture kind of explains it. Imagine you have 12 single family properties versus one multifamily apartment. With 12 single families, you've got 12 roofs that need repairs. You have 12 mortgages that you have to sort out. You have 12 insurance policies that come different times of the year that you've got to renegotiate. You've got 12 properties to visit. Hopefully they're within the same area. And you've got increased management fees. Typically in the single family, if you're going to hire property management, you're looking at 8 to 10% of your cash flow is going to be going to the property management company. In multifamily, it's a whole different ballgame. You've got one property, 200 units under one roof, and it's much easier to manage and oversee the whole thing. Less time on your part.
I want to talk about how raising rents can help create huge value. And to me, this is a huge value add opportunity, especially when you find a property that the rents are lower than all the other surrounding areas. If we just take a simple math problem here, and if you've got 165 units and you raise each unit by $10 a month, now does that sound like a lot? That's less than 1.5% raise. I know that here in California, especially in Orange County, we're seeing rents going up 2 to 3% is what was in the paper this past Sunday. So using a conservative, just 1.5%, if we raise the units, 165 units by $10, that increases our cash flow of $1,650 in 1 month. Now you multiply that times a whole year, that's almost $20,000 of additional income you've gotten just by raising 1.5%. Now, to try to create value of that, a simple rule of thumb is to use a multiple of 10. So you take that and multiply it by 10, you've increased the value of your property almost $200,000 by just raising it 1.5%. Now, if you take that over a 5-year period and multiply that out, you've increased the value of your property by almost $1 million. That should be something that should attract almost anyone to the game, whether you're an investor or a buyer. But you can see how it increased drastically in a larger complex. We only look at 150 units and above, upwards to under 300. So the value increases much faster. The dollar amounts multiply much faster, much more than you can if you had, say, a fourplex.
A lot of people are asking why the Texas market. We're from Southern California. Southern California is great, but we just don't have the stability in Southern California that we have found in Texas. Texas has got a great population growth, 17% increase since 2000, and most of the people from Texas are coming from California. Texas has an economy that's international. They have less tax. They have affordable housing. They're, where are we here? They have the below national for unemployment, much better than the other states. They have a stable job market with growth and diversification. Their job markets, they have the energy corridor out there, they have strong medical, they have the ports, they have oil, they have very lot of diversification to be able to hold the job market. Texas is ranked number 3 in the business climate. And the rents have been stable for years and years, no major highs and lows like in California. There has not been a big bubble that has been pushed.
Another reason why Texas is in California, and I know a lot of other states, especially in the Northeast, if you have a tenant there that's not paying quite good, or just, as we call them out here in California, professional renters, they know how to play the game. And it takes almost 3 months to go through the legal process and get someone evicted out of the apartments. In Texas, it's 3 weeks. If they don't pay, you file the note and they're out within 3 weeks. So that helps you on your cash flow.
This graph just confirms the Texas and the unemployment rate. You can see California, number 1 for something, unemployment, 12.5%. It's come down a little bit now. The national average was 9.7 and Texas was 8.2. This was a couple years ago, but it just shows the trends on where we've been staying with all the unemployment and what makes Texas so popular for our apartment properties.
As I said earlier, our acquisition criteria consists of looking at units that are 150 up to 300 units. We feel like that is the best area. And as I had mentioned earlier, I have bought, I have built, and I have managed units anywhere from 50 to 150. And I have to tell you, there's more work in the 50 unit than there is the 150 unit. You still have to have a management. You still have to have maintenance, whether it's 50 or 150. So if you're spreading the maintenance costs out over more units, it's less cost per unit, therefore making you more money. We always look in the A and B locations. It'd be great to have a B property in an A location. You never want an A property in a C location. We completely stay away from the D-type units. There, you go in there packing a gun. We want to stay away. We want the A and Bs. I don't have a problem with a C and a B location. Years of construction, we like to stick around the 1980 and up. You get below 80, and I believe it's 77 or 76 is when they outlaw lead paint. So we tend to stay in the early 80s. The newer construction, the newer types of methods that have occurred over the years. And again, as I mentioned earlier, the current positive cash flow, that's what we're looking to have. And we're looking to add value through the cash flow by finding properties that are undervalued in rent and that needs very little in deferred maintenance, where we can come in, spruce up the landscaping, throw in some new appliances, throw some new paint on it, and raise the rents 1.5% to 2% the day we take it over, and create the value for our investors that way.
Whenever you're working with somebody that's going to be working with your investment, make sure they've got a very strong team of professionals around them. You want to make sure they've got a good real estate broker that's looking out for your best interests. Are they really finding the good deals for you, or are they sending you the junk stuff that nobody else wants? Make sure you've got a mortgage broker that understands you. You can get pre-qualified. You know what type of a property you're looking at, and you know that this mortgage broker is going to give you the best rate. Your team should also include an SEC attorney. These are extremely important documents that protect the investor and your entire investment. All of these documents are drawn up by an SEC attorney and filed. We use an estate attorney because many of our investors work with trusts, and we also work with Carr and Hall, the people that want to work with their self-directed IRAs. We use a real estate attorney in Texas, which is where our properties are, so they can review all of our contracts. And if we have any issues in Texas, we've got a real estate attorney that's part of our team that can handle that. And we use property management company. We have worked with a couple of different property management companies. We find them that are very well established, fully insured. They have a lot of resources for the quality employees that you want overseeing your property, and they've got the buying power if you're going to go in and buy appliances, and they're large enough where they can handle all that for you. How investments are structured. There's a lot of different ways of structuring, but we feel that this is the safest in talking with all of our lawyers. The syndication with the private placement memorandum. This document describes how the investment is structured, how the distributions are going to be given out, what kind of yields you're going to have, what kind of equity that is going to be at the very end, what your percent of ownership will be. The operating agreement is another document that the lawyer will draw up, which talks about how this LLC that holds the property will be structured. Who's in charge of what, how it's formed, who files things. And the Regulation Ds are filed with the SEC by our attorney. And the equity investors who come into a property will own the property through the LLC. They will actually be in ownership of the LLC. What investors should expect. If you're an investor in anybody's property, you really should expect monthly executive summaries. You want to know what's going on in your property, what is the occupancy, how is the cash flow going, what's a summary of everything that's happening, what kind of capital expenditures have you had, what type of marketing is going on. This is important, so you should always know what's going on. Full disclosure and transparency. Financials are always open to all investors. If you have a person that you're working with that doesn't want to show you everything, I would question where your investment money is going. We collect a 90-page financial summary from our property management company on a monthly basis. This is available to all investors anytime they want. Typically, we do a summary of this entire pages, but you're always welcome to take a look at it whenever you want. We fully comply with all SEC guidelines. Absolutely, that is top on our list. We never want to go around any of that. And we personally invest in our properties. We feel that these are great opportunities that we're offering to outside individuals, and we want to have skin in the game. These are good investments for us also. If you're working with somebody that doesn't want to put any of their own money in it, I would question what type of a property you're in.
We typically try to invest a minimum of 20%, sometimes upwards to 50% of the deal ourselves, and that should go a long ways with investors when we have a lot of our skin in the game. As I said earlier, we like to try to get the value add opportunities, and so if they're good enough for me, they should be good enough for the other investors. So that's the reason we put our money where our mouth is before we ever ask one penny from our investors to go into the deal.
Just to kind of give an example of $100,000, some options you may have of what to do with the $100,000 and what it would look like in 5 years. I'm going to be really generous with the CDs, and I'm going to say you could find a CD for 1.25%, which is pretty unheard of right now. But let's give you 1.25%. In 5 years, that'll be worth $106,500. Let's say you have an IRA and you're working with it and you're finding some good marketing things for your IRA. A 2% return in 5 years, your $100,000 will now be worth $110,000. In the infamous stock market, let's see, what can we do to predict where you're going to be in 5 years in the stock market? Well, about the only thing I could put in here is you could either lose it all or you could make it really big at $500,000. That's a crapshoot. That's a high risk, especially right now with the crazy roller coaster of the stock market. With a multifamily syndication, if you put $100,000 in a typical property, within 5 years, you would have doubled your money. This includes the distributions that you would be getting, whether it's 6, 7, 8, 9, 11% over the 5 years, plus your equity at the end of the sale. The typical one comes out to about $200,000. This is who we are right here. We had the pleasure of meeting George Ross not too long ago, though he's also on The Apprentice, pretty great guy there. And we had the opportunity to talk with him. We've kind of finished up our presentation here. What I'd like to do is toss it over to Karen Hall from UDirect IRA and let her talk for a little bit. And then we'll open it up to some questions and hopefully be able to get everybody's questions answered for them.
There was one thing that you brought up that I wanted to expand on just a little bit real quick. You were talking about recourse and non-recourse loans. All of the apartment complexes that we own are non-recourse, and there's a cutoff of around $3 million. Anything below that, the banks are going to look at you, the borrower, to make sure that you can financially absorb any losses and not the bank themselves. And the down payment is usually much higher on a 4-plex or 8-plex than it is on a 150 unit and above. Typically, we used to be around 10%. The economy hit, it dropped to 25, 30, and now we're back around 20% down. There's no personal guarantees on this. If something happens to the property, they don't come back to me, they don't come back to our investors, because the bank looks at the property and they look at the business side of it. So they're loaning money on the property itself. Of course, we still have to qualify, and we do that without the investors. There's a whole bunch of questions here. We'll try to get through some of them. We got a few minutes left, and I think Karen wants to address a couple of them real quick.
Yeah, we have a couple questions here from people. I want to be sure and I can answer some of this. Thomas asked if people can participate if they are not an accredited investor. We can take a very few non-accredited investors. We are limited by the SEC on how many that we can take on this, but it's something each individual offering that we have can be discussed at that time, and it has to go through our attorney also. And it has to be a sophisticated investor, means somebody that has a lot of experience in real estate but maybe doesn't have the financial net worth, and that's called a sophisticated investor. So that is a possibility. Aaron's asking about the type of returns that we're seeing in multifamily. The returns we've been seeing is anywhere from like 8 to 11% annual returns. Typically on our properties, we give distributions to all our investors 4 times a year. On our last acquisition, the Crystal Falls that you saw the photo of, that was a HUD deal, and HUD would only let us do distributions twice a year. But they were pretty happy getting their 9% twice a year, so that was not too much of a problem. What are the typical management fees on a multifamily per unit? And that's, Josh asked that. That's a great question. The fees on that are anywhere between 3 and 5% is what we pay the property management fee to oversee everything. And then on top of that, we have to pay for any employees that are there. But they take care of all the bookkeeping, all the evictions, the day-to-day operations. They get prices for us. They help buy us new appliances or whatever we need in bulk. They have carpet deals. So it's very much worth it.
But again, that's only the larger 150 units and above. You get into the smaller units, the 50 units, they're going to be upwards to 8 to 10%. So again, being able to invest in the larger deals, the economy of scale kicks in.
Josh also asked about the difference between the A and C properties. That's a real good question. You want to explain that?
The difference between A and C is basically location and the type of property that you have. Typically, the units anywhere from, I'd say, 79 upwards to 90 is going to be your better class of the C properties. You get in above from 90 to 2,000. You can actually have some A properties in the 2,000 if they've been rehabbed and they're in good locations. But typically, the A properties are running from 2000 to 2010, 2011. The newer properties are fresh out on the market. And between those, you've got the B properties, which are excellent, anywhere from 90 to 2000, like I said earlier. But those are good properties. They're higher priced. And that's the reason we'd like to stick to our B and C properties. They're more priced where most people can afford to get into the deals, and we're not out there having to raise $10 million to buy an A-class property.
The B properties also tend to be the most stable tenants. The A people tend to live in apartments knowing they're going to be buying a house, or it's transitional, or they've been changing jobs. The C properties, you have a lot more people doubling up. The units get damaged. But the B properties, you tend to have more of the city worker. You have more nurses. You have more teachers, firefighters. Those are the people that are in the B properties, and they have a lot more longevity, so you have a lot less turnover.
And a lot of the C properties you'll find, and we see it in our properties, that there's tenants that have been there 15, 20 years, and they absolutely don't want to go anywhere because they love living where they live, and they don't want the hassle of moving. And that's, as Karen said, you'll get that in the A properties and a lot of the Bs, where they're transitional. They don't mind paying the higher dollar for a newer place because they know they're only going to be there a short time, in lieu of the smaller the C properties, the B properties. And again, as we mentioned earlier, the D properties we stay away from completely because we don't care to fix bullet holes in the windows.
Only a couple more questions here. A couple people asked the same one. What is the minimum investment? With our company, it depends on the property. Typically, it's $100,000. We do have opportunities for $50,000 at time, but we haven't gone below $50,000 with the type of properties we have because we don't want so many investors that you lose the personal touch, and that's something that we strive for.
Josh also asked a good question here. What is the holding time? One of the things that used to be, when the market was extremely good, you could flip these properties in 2 years and make a huge return. And then it went to 3 years. We're on all of our properties now, we're at a 5-year hold to create that value so that we can double our investors' money. If you decide to invest in a property that we have, which we don't have any right now, we're looking, but you would take your money, you would either send a check or wire transfer directly into a trust account that is set up with a Chicago Title. That's who we use in Texas. They hold the money in the trust fund. It never comes into our bank account. We never touch the money. If for some reason the deal goes sideways, we instruct the title company to return all the funds to the investors. So it's not a Ponzi scheme or anything like that. You hear all these guys out there, as in any type business, there's going to be some bad apples out there that kind of taint it for everyone else. But we like to say that we're one of the good guys out there. But again, we never touch your money. It goes straight into the fund. And if, like I said, if it's some reason it goes sideways, it goes right back to you.
And once you do put your money in, you cannot come out early. It's not like a REIT where it's a stock and you can go in and out of properties. Once the investment's made into our property as a syndication, that money is locked in until we sell the property. And this is all written into the private placement, so you have full understanding of what the goals are, and you can make your own decision at that point in time.
There is language in the PPM that states if for some reason you have to get out, you can make the offering to the existing investors, and they have the option of purchasing your shares. But other than that, you're in the deal.
You're in the deal. As Karen was mentioning with the IRAs, this was really important that we brought her in. Approximately half of all of our investors do use their self-directed IRAs, which is why we've partnered up with Karen so well and to bring out this information, because so many people are not aware that this is a great opportunity. I'm looking at some of our questions. We're kind of getting down to the end of it. I have several people that love Texas. I have several people that said that Texas is awesome. Lots of jobs there. Someone owns houses there. I have a feeling they live in Texas at this point. Let's see. I'm going to give it a few more moments to see what other questions we have here. What happens in a case of foreclosure? All the investors are always notified about everything that's going on. Major decisions are never made without the investors' involvement in everything, and everybody gets to speak their mind and see what happens. I can't say what happens in foreclosure. We've never even been close to foreclosure. It's never happened. We don't buy properties that are not stabilized. We have a lot of low-risk investors, and this is what they prefer.
That was a problem on a lot of multifamily, that the investors were going out there and they're buying on a 2 and 3, sometimes 4 cap deals. And those were just not making any money. They were betting on the come. They were thinking that the economy was going to keep clicking right along like everyone else did for a long time, and appreciation was going to come just because of time. And these people got caught up, and all of a sudden they dropped down and they couldn't make their payments. But we're not doing that. We're buying multifamily deals based on existing cash flow, not on performance, not on what someone else tells us that they think the property can do. If the owner tells us that, then we tell them, hey, you make it do that, you get the income and expenses to where you think it is on performer, then we'll pay you for the performer. But otherwise, we're going to pay you exactly what the cash flow is. If it's getting 85% occupancy, we're going to buy the property based on 85% occupancy, not 100. And that's the value add that we like to look at.
Josh is asking one more. Is there any type of interest paid in the money while it's Chicago title? We were instructed last time, our last acquisition, that the money was in there for less than about 2 months, maybe 2.5 months, and that the interest would have been less than 0.5%. And the hassle of doing 1099s for everybody for about $20 was not worth the effort. So that we did not recoup any interest in the Chicago title while we were waiting for the property to close. Let's see, do we have any more questions out there? Can the investors remove the managing partner for non-performance, John? That's a good question. This is actually all written in the private placement memorandum and in the operating agreement. There is a way that this can happen, that all the investors can remove a managing member for whatever reasons, but it's all written down in the operating agreement that you would see before you sign up for any of our opportunities. Well, we're kind of getting to the end here. Karen, do you have any statements that you'd like to make before we close out of everything?
Well, just to, again, offer, my services if anybody has any questions. I'll say that, hit me up as a friend on Facebook. You can. I've got a Facebook fan page called Self-Directed IRAs. It's plural. So, become a fan of that, and then you can post your deals and ask about deals, or if you've got money you're looking to put it into a deal, you can post it on there. Or find out about educational events. So just a little something you can do while you're on your computer right now. Just go to Facebook and look up self-directed IRAs and become a fan.
If anybody has any other questions for either Karin or Stan or myself, our email addresses are right there on the screen, or our websites or phone numbers. Every way to get a hold of us possible is on the screen. So I want to thank everybody for watching. We had a fabulous turnout, much more than we ever expected. This is just wonderful. And I want everybody to have a really good evening, and thank you for listening.